We'll do question number 10. I don't expect this to be tested in exam, but this is a fantastic question to understand your capital budgeting provisions. Whatever we see in capital budgeting, the rules of capital budgeting gets tested really well in this question. Go through question 10. Page 157, question 10. Excellent question to understand in detail. This will go on for maybe 1 hour, but it's an excellent question to understand capital budgeting. Friends, no discussions, please. Go through this question. It'll test a lot of concepts, so I would want you to pay more attention to the problem. Go through in detail. I'll start explaining this question now. Perfect Inc., a US based pharma company, has received an offer. They are planning to set up a joint venture in India. Their revenues will be 55% of revenues plus a royalty at US dollar 0.01 per bottle. Some initial investment of 200 crores is to be made. Also some working capital of 50 crores will be required. As per GOI direction, the price will be 7.5 and production will be, the price in addition to inflation shall be increased by 1 each year. The price will go up by 1 rupee each year, and on top of that some inflation adjustment can also be there. Production cost shall be 40%. Applicable tax rate in India is 30%, 35% in USA, and there is a DTAA. So somewhere some part of your normal taxation understanding will come into picture. I've seen this question, so what they have done I can explain, but I'm not very sure what exactly your DTAA talks and all. But somewhere what is required to solve this question, I'll try to explain here. So according to the DTA, there will be some credit given in US for the tax paid in India. In both the countries, taxes shall be paid in the following year in which profit have arisen. So I will make profit in first year, but tax will be paid in the second year. That's what the question says. You will make the profits in year 1, but the taxes for that will be paid in year 2, and that is what is the scene in both the countries. Spot rate is this. Inflation is 6%, expected to decrease by 0.5% every year, and in US it's 5%. Also there is some restriction on remittance. You will have some restriction on repatriation. So the restriction is only 50% can be remitted in the year in they are earned, and the remaining in the following year. They cannot end up remitting the entire amount to the parent. So in India you are going to set up a subsidiary or set up a joint venture. Once you set up a joint venture, that money whatever you earn will not go back to the parent immediately. 50% in the current year, 50% in the next year. So WACC of Perfect Inc. is 13%, but due to risky nature it expects a return of 15%. So the parent is expecting a return of 15%, Determine whether Perfect Inc. should invest in this project or not from subsidiary point of view. Should invest in this project or not is the final requirement. Now, some issues which can come in the question is, I have two currencies, one is INR, second is your dollar in the question. Parent entity is based out of which country? US. So their investments, they will invest dollars, dollars will get converted into INR and the investment will be made. Who expects this return of 15%? Is the parent expecting a return of 15% or the subsidiary expecting a return? Parent is going to make the investment, parent is expecting a return of 15%. If I have to evaluate Indian entity, that is if I calculate in INR the cash flows and evaluate, I cannot use 15%. 15% cannot be the discount rate for INR cash flows because parent is expecting 15%. Also in this question, I will not be in a position to convert this rate into the US rate because I don't know the risk-free rate of India. I have no idea on what is the risk-free rate of India. I have no idea on what is risk-free rate of US. Inflation can be a proxy, but there also a problem is inflation is changing every year. Inflation is changing every year. Inflation is not remaining constant. So the only other option, if at all I want to do in INR, if I am left with no choice and I still have to do in INR, then I will have to take different discount rates for different years. I will have to take different discount rates for different year because I may use a formula called as 1 plus risk-free rate into 1 plus risk premium is equal to 1 plus risky rate. Risk-free rate is equal to inflation. Risk-free rate is equal to inflation because inflation is one component of your risk-free rate. So if you take that logic, the risk premium will be different for year 1, year 2, year 3, year 4, year 5, year 6 because the inflation is different for different years. Clear? Any doubts till this? So I can go for INR cash flow with different discount rates. What ICI has done, not very clear. I initially thought maybe they want us to do in INR. They finally converted everything in dollars and did the cash flow analysis in dollars. That is what is possible. Mostly what is possible because if I try to do INR cash flow, there is scope for a lot of assumption. So in this question, what we are going to do is every step, first we will do INR, use IRPT or PPT, get the exchange rate and then convert into dollars. So dollar conversion will happen at every stage, but my initial calculation may happen in INR. I'll then convert into dollars and then finally when I'm converting in dollars, I also need to take care of the repatriation clause which is there because from a parent point of view, subsidiary earns 100 crores in year 1, but I don't get that 100 crores, then my cash flow is not 100 crore. From a parent point of view, we'll have to think what is their outflow, what is their inflow. Parent's outflow will be the initial investment which they make in India. Parent's inflow is whatever this Indian subsidiary repatriates to the parent with adjustment for tax in USA. There is some tax which USA government is also going to charge. What is the tax rate in US? 35%. What's the tax rate in India? 30%. So there is though a double taxation avoidance agreement. So whatever they pay there, the credit can be taken, but still there is something extra going to be there because 35% is the tax rate in USA, 30% is the tax rate in India. It will not be exactly 5%, you will understand as we do it, but there is going to be some taxation paid in US. So basic thing I want to finally calculate in this question is what parent is going to invest in day 0 in terms of dollars. In terms of INR, I know the number, some 200 crores something is given, but I would want to convert it into dollars. Then in year 1, will the parent get back something and what tax they will pay in US? Year 2, will the parent get back something? Year 3, will the parent get back something? Year 4, will the parent get back something? Year 5, will the parent get back something? So whatever they are getting back, once you find that, then you do a discounting of this cash flows and get to know the NPV of the project. So it's basically in place of this US based company, I can even think of an individual investor. He is investing in this entity. So I am now bothered about knowing what will this individual investor get rather than what the Indian subsidiary is going to earn. To get to what the parent is going to get, I will have to analyze the Indian subsidiary's cash flow. Any doubts till this? So if Indian subsidiary is earning 200 crores, parent will get some share of that based on the repatriation clause, whatever is there. Clear? Let's start. Working note 1, initial outflow. Working note 1, initial outflow. Particulars, amount in bracket INR. Amount in bracket INR crores. Working note 1, initial outflow. Particulars, amount in INR crores. Capital expenditure. Amount in INR crores. Capital expenditure. What's the capital expenditure which is going to be done? 200 crores minus 200. Excellent problem to understand capital budgeting and understand cash flows. Capital expenditure is 200 crores. Working capital, how much? 50 crores. Initial outflow, I'm not getting into the parent analysis as of now. I'll have to finally convert this into US dollar. So we'll see that in some time. So my initial outflow is 250 crores. Initial outflow is 250 crores. Working note 2, in between flows. In between flows. Is it going to be same cash flow for all the 5 years? Or do you see difference happening? Why will it vary? Your selling price itself undergoes a change. How many years is the project? 5 years. How many years should I calculate cash flows? Think and let me know. 5 years is the project. How many years should I calculate cash flows? It will be 6 years, because whatever you earn in 5th year, the tax for that will be paid in the 6th year. The tax for that is going to be paid in the 6th year, because taxes are paid 1 year in arrears. They are paid in the following year, they are not paid immediately. That's what is the question. From India's context point of view, normally taxes are paid in the same year in which it is earned, because of advance tax provision. Because of advance tax provision, corporates end up paying tax throughout the year. They end up paying tax throughout the year. So normal analysis is, my tax is paid immediately when the cash flows are earned. It's in fact like a monthly tax payout. So we pay it in 4 quarters, but logically speaking, it is not that I wait for a year and then pay the tax. I end up paying the tax immediately because of advance tax provisions which are there, and most of the countries has those provisions. Particulars in 6 years. Particulars in 6 years. Again in crores. I'll write the format. We may have to do a separate working note. Revenues less cost, PBDT less depreciation, PBT less tax, PAT. Something else can also come after CFAT. Some additional calculation can be there. Revenues will need an extra calculation. Revenues will need some extra computation. Revenues less cost, PBDT less depreciation, PBT. This is the format to calculate your in-between cash flows. There will be something needed after CFAT. You will need something else after CFAT. I'll explain that later. Leave some 5-6 lines. Note 1, computation of revenues. Computation of revenues. Computation of revenues. Okay. Now it's a joint venture agreement. In the joint venture agreement, what's happening is this Perfect Inc. is going to take 55% share of revenues and a royalty payment of US dollar 0.01 per bottle. These are the two numbers which is going to come to the parent. So when I'm evaluating the cash flows, I'm not bothered about the balance 45% because that's not going to come back to this guy. So finally I'll calculate the subsidiary cash flow, but I want to calculate a portion of subsidiary cash flow which the parent is going to take, because balance part will go to this other company 8 Square Limited. They are going to take the balance part because it's a joint venture. Some amount will go to them. The agreement says that Perfect Inc. will get 55% share of revenues plus a royalty at US dollar 0.01 per bottle. I'm got stuck here because some cash flow is going to be in US dollar. I will need the exchange rates. Once I have the exchange rates, then only I'll be in a position to compute the revenue. So somewhere exchange rates will be needed. I'll come to that as we do. Point number 1, units sold. Units sold. How many units are sold? How much? 24. Pre-inflation adjusted price. Pre-inflation adjusted price. What's the price going to be in year 1? 7.5. This is without giving effect to inflation. The question says, as per GOI direction, it is estimated the price will be, the price in addition shall be increased in addition to inflation of respective years shall be increased by 1 each year. So the price is going to undergo changes because of two factors. One is inflationary condition. Second is price as such is going to go up by 1 rupee. So 7.5 becomes 8.5. I'll do the third and fourth. There is scope for taking a different assumption. I'll explain when I'm done with that calculation. I'll try to follow maximum what ICI has done. Their answer is also logical, but there's scope for other assumptions. Point number 3 is inflation rate. Read it carefully and tell me the inflation rate of India for year 1, 2, 3, 4, 5. Read it carefully and let me know this inflation rate. Year 1, what's the inflation rate? 6%. Then year 2, 5.5. Then year 3, yeah, please participate. 5%. It's going to reduce by then 4.5. The question has mentioned that inflation is 6%, expected to decrease 0.5% every year. That's the inflationary condition as far as India is concerned. You start with 6, it will come down to 5.5, it will come down to 5, it will come down to 4.5, it will come down to 4. Now, what institute has done, final selling prices, don't be in a hurry to note down, please listen, try to focus on the calculation. So institute has taken final selling price like this. They took the pre-inflation price, added the inflation. The only area where I thought it could have been slightly different is year 1 final selling price itself could have been 7.5. The year 1 final selling price could have been 7.5 because the question talked about the selling price will be 7.5. So my understanding was that maybe inflation is adjusted there. Year 2 onwards, I don't have a problem with that. They said it will go up by 1 rupee, and on top of that, inflation adjustment needs to be done. So it will go up by 1 rupee. On top of that, some inflation adjustment is to be done. Wait. Here also, when it goes up by 1 rupee, two ways of interpreting. One person can interpret saying that this 7.95 will go up by 1 rupee, and then the inflation will come into picture. And then on top of that, inflation will come into picture. So there is a possible assumption. The possible assumption is my year 1 price is 7.95. I will first add the 1 rupee increase and then add the inflation increase. What ICI has done is that took 7.5, increased every year by 1 rupee and then gave effect to inflation. In fact, it can reach a stage where if inflation rates keep coming down, you may not even see a price increase of 1 rupee. So, in reality, if you see here, the price is not even going up by 1 rupee. The price is not going up by 1 rupee because we are trying to add 1 rupee to 10.5. After adding that 1 rupee, you are giving effect to lower inflation rate. You are technically giving effect to lower inflation rate. This is what they have done. I will try to follow this, but there is scope for different answer as far as this part is concerned. Year 1, my final selling price can be 7.5. Year 2, my pre-inflation price will be 8.5, 8.97 if I start with 7.5. Year 3, pre-inflation price will be 9.97. That is 8.97 plus 1 rupee, 8.97 plus 1 rupee, then give effect to inflation. 9.98 plus 1 rupee, then give effect to inflation. I don't see this question to be tested in an exam kind of a scenario, but it's going to cover a lot of concepts at multiple places, and obviously there is scope for multiple answer based on the assumption you take. So this is what they have done. So right till this, my final selling prices are this. These are the final selling prices. The only thing is the scope for assumptions at multiple places, and every time there is a scope for assumption, you understand different concepts. Any doubts on the final selling price? Multiply this and get the revenues. Clear? Any doubts till this stage? We have got to the revenues number. Any doubts till this stage? Done? Okay, now listen. From a perfect ink point of view, listen for some time. You got till revenues number. Anyone still working? I'll wait. Anybody still calculating the revenues amount? Okay, now listen. From a perfect ink point of view, parent is going to get only 55%, balance 45% will go to the other partner who is there in this. There are two partners, so the other partner is going to get share of 45%, the parent is going to get share of 55%. So this is the parent share. On top of this, add royalty and final revenues. Now for royalty, I will have to go to a note 2 because my royalty calculation can be done in US dollar. Royalty calculation can be done in US dollar. I cannot add them, so I'll have to convert that US dollar into INR. So right, next parent share 55%. Parent share 55%. Parent share is 55%, add royalty and final revenues. Okay, come down. Note 2, computation of royalty. Let it be 6 years again. Computation of royalty. Parent, that Perfect Inc. is eligible to get all these amounts. They may not get it immediately because of repatriation clauses. So they may get it slightly late as well, but they are eligible to get this. For royalty computation, I need exchange rates, and exchange rate is going to come through purchasing power parity theory. Point number 1, inflation in India. In bracket, home country. Inflation in USA. Though I have explained this multiple times, but still some of you have asked me this doubt. Say, listen, in this case, the home country is USA. USA is making the investment. But when I come to IRPT or PPT, for me, the first currency is the home currency. Second currency is the foreign currency. That be very, very clear, because some of you have still asked me doubts on those. Home currency will always be the first currency in the quote. The quote is, I think, initially rupees 57 per dollar. That's the quote given in the question. So if I go by that quotation, INR is the home currency and US dollar is the foreign currency. Somewhere the rate was there. Yeah, the spot rate of dollar is rupees 57. So INR will be the home currency and dollar will be the foreign currency for the purpose of IRPT and PPT. Now let's write this inflation. Year 1 inflation in India was 6%, then 5.5, 5, 4.5, 4 and 3.5. What was the US inflation? Every year it's 5%. Exchange rate. Now my exchange rate calculation, I am just showing it, but I will not do a detailed calculation. It would have been 1 plus IH, which is 6%, divided by 1 plus 5% equal to F1 by 57. Like this you will get the first year. Second year it will become 1 plus 5.5%. Third year it will become 1 plus 5%. Fourth year it will become 1 plus 4.5%. It goes on like that. So my year 1 calculation is 57 into 1 plus 6% divided by 1 plus 5%. 57.54. Like this you will have to end up calculating for every year. Use purchasing power parity theory and forecast the exchange rates. One plus India's inflation divided by 1 plus US inflation is equal to F1 by E0. So finally F1 is equal to 1 plus India's inflation into the spot rate divided by 1 plus US inflation. There onwards F2 is based on F1, F3 is based on F2. It goes on like that. forecast the exchange rates. 1 plus, this is the calculation, 1 plus 6% divided by 1 plus 5% is equal to F1 by 57. This will give you F1. Then 1 plus 5.5% divided by 1 plus 5% is equal to F2 by F1. Then 1 plus 5% divided by 1 plus 5. Then 1 plus 4.5, 1 plus 4, 1 plus 3.5. Initially, rupee will depreciate and then finally rupee will start appreciating because India's inflation will go lower than US inflation. 57.54, 57.81, 57.81 comes down to 57.53, 56.98 and 56.17. Any doubts on this? Clear? Any doubts on exchange rates? Clear? Then point number 4, royalty in USD crores. Royalty in USD crores. As per my terms, I have to pay a royalty of how much per bottle? 0.01. So 0.24. This is the royalty parent will take away. 0.24. This royalty parent is going to take 0.24. Royalty is 0.24. 24 crores into 0.01. Question has not said that royalty will be for 55%, royalty will be for the entire amount because they are giving the technology. So when you give the technology, they'll end up taking the entire royalty on the entire sales. As per GOI direction, price per as per the joint venture agreement, Perfect Inc. will receive 55% share of revenues plus a royalty at US dollar 0.01 per bottle, and that is on the entire 24 crores of bottles. Clear? Any doubts till this? So I'll now convert this into INR. Royalty in INR, 2 decimal. Sorry, year 6 royalty will not be there. Royalty in INR. This is one major chunk of the calculation. Now onwards it will be slightly simple. The major chunk is on the revenues part and the repatriation amount calculation. These two will be little tricky. Royalty in INR is 13.81, 87, 87, 81 and 68. Any doubts on this? Any doubts on this calculation? You have a doubt, let me know, I'll clarify. Now I take this royalty up here. And this is what the parent is going to get, or is eligible to get. The parent is eligible to get this amount. Any doubts in these numbers? Clear? Can you proceed? So coming to this revenues, copy these numbers. These are the revenues of this project. Revenues of this project from a parent point of view. Project is likely to give so much revenues to the parent entity. the the parent is likely to earn this amount, 118, 132, 145, 158 and 171. Any doubts on this? Everyone done till this? Now expenses of this project is 40%. Somewhere the question has said the cost is going to be 40% of the revenues. It is mentioned the production cost, the production cost shall be 40% of the revenues. The production cost shall be 40% of the revenues. Entire royalty paid is so I also thought about that. The issue is this royalty is going to be an income of the parent. So from a parent point of view, they are going to get an income. The only thing is my cost when I do calculation, it could have been 40% of this number, not the royalty, sorry, 40% of this number, parent share. 40% of the parent share rather than adding the royalty and then considering it. I think ICI has done it on the final number. That's what I think. Royalty is anyway an expense of the subsidiary, but it's an income of the parent, so I'm not bothered about that point. So parent is going to get 104 crores, parent is going to get 13 crores. Against this 104 crores, parent will spend 40%, or the joint venture partner has to spend 40%. I think institute has done it on the final revenues. That's what I remember. I may be wrong also, but see, the production cost question says is 40% of the revenues. That 40% can be on this number. The 40% can also be on the final number. The 40% can also be on the final. See, royalty technically is neither an income nor an expense from both parent and subsidiary put together, but the parent is going to get this money in addition. So I am trying to finally calculate what is the parent going to get out of this project. That's my objective. Objective is to find what is the parent going to get out of this project. So coming to this expenses, we have taken 40% of the overall revenues. 40% of the overall revenues. Get the PBDT number and tell me the depreciation. Get PBDT and tell the depreciation. The issue is for new syllabus capital budgeting is not there. Because of that, problems like this will look more tricky. If capital budgeting was there, you end up seeing similar problems there. There we gradually increase the difficulty level, because in capital budgeting I end up solving some 30-40 questions. So here I don't have that flexibility to solve so many questions. So this is like more advanced set of a question which is there. How much will be the depreciation per year? What was the original investment? 200. Salvage value is 5 crores and depreciation is 20% of the net salvage value using straight line method. Technically it's 200 minus 5 divided by 5 years. 200 minus 5 divided by 5 years. So 39. PBT PBT number. What's the tax rate in India? 30%. Any doubts till PBT number? The major chunk is revenues. I don't have much beyond that. Once till I get to the repatriation calculation, till this the revenues is the major chunk of the computation. Now coming to tax, it's like this. This previous year PAT or previous year PBT into 30%. Previous year PBT into 30%. That's how I'm going to calculate the tax. I'll take the previous year PBT number and then compute the tax at the rate of 30%. Take the previous year PBT and multiply it at 30%. Tax is paid 1 year later. So we take the previous year PBT number, multiply with 30% and get to the tax amount. One year it will be negative number. I cannot technically call this as PAT. In my books of account, this may not be the PAT, but this is the PAT from a cash flow analysis point of view. Or technically, before considering depreciation, this will be the money which I would have earned. 30% of the previous year number. Add back depreciation. Get CFAT. Add back depreciation, get CFAT. Once we are done with repatriation analysis, things fall in place. That's what the problem is all about. I will have to do a little bit of analysis on the repatriation part. Okay, after CFAT, I will have an adjustment for one item, which is every year my working capital increases. There's an increase which is going to happen on the working capital front. What is the increase they are saying? 5 crores. So less increase in working capital. You would have seen this in cash flow analysis. In cash flow statement, if working capital goes up, it leads to reduction in my cash flows. So I have to spend more money on working capital. Because of that, my cash flows are going to be impacted. How much is the extra increase? 5 crores. I'm writing only for 4 years. 5th year the project will get over. So there's not going to be increase. Whatever amount is there in working capital, entire amount will come out. In year 3, the entire amount is going to come out because the project is over. The project has got over. So entire money which is stuck would have come back to the company. Any doubts on this? There is a 5 crore increase somewhere mentioned in the question. It says an initial working capital and thereafter 5 crores will be required each year. So you will need 5 crores each year, and we get to revised CFAT. Revised CFAT. Which one? Yeah, we have considered 5 crore. No? So initial working capital means day 0 is 50 crores. At the end of year 1, another 5 crores will get added. Year 2, another, and finance assume cash flows will happen at the end of the year. So all these numbers are technically end of year cash flows. So my revised CFAT is 66, 64, 70, 75, 86 and negative 19. Any doubts till this stage? Any doubts till this stage? You may have to go through this problem again once at home to understand the detailed calculation, because there's too much of computation here. But in between you'll keep learning some or the other concept. Any doubts till this? Can we proceed? Now before doing, I just want one small number here which will help me in doing some tax calculation, which is tax paid in India in US dollar. Why I'll need this is I'll have to take tax credit. I'll have to take tax credit when I do US calculation. So whatever taxes have been paid, you divide it by the exchange rate which is there. This will be needed later on. Divide by the exchange rate. This number will be needed later on. This is the tax which has been paid in India. I'll need this number later on. Whatever taxes have been paid in India, divide it by the exchange rate. This is tax paid in India in terms of US dollars. Reason for calculating this is I am not going to pay entire tax in US. When I am going to pay tax in US, I will take credit of this and then pay the balance amount. Any doubts till this? Can you proceed? Working note 3, terminal flow. I'll come to repatriation analysis in some time. Terminal flow, particulars and amount. Terminal flow, particulars and amount. Particulars and amount, terminal flow. Point number 1, net salvage value, and point number 2, recapture of working capital. Net salvage value and recapture of working capital. Net salvage value and recapture of working capital. How much will this machinery realize at the end of 5 years? 5 crores, and working capital will get released to the extent of 70 crores. Working capital will get released to the extent of 70 crores. What is 70 crores? Is 50 crores initially stuck, 5 crores each year. So you finally end up getting 70 crores release. Net salvage value 5 crores, recapture of working capital 70 crores. Total terminal flow. 75 crores. Total terminal flow is 75 crores. Total terminal flow is 75 crores. Any doubts on this? Clear? Working note 4, repatriation analysis. Repatriation analysis. in that, start with writing that CFAT number. Okay, now listen for some time and then you can note it. Listen, I've written the CFAT amount. Listen, what parent is going to get is 50% of current year, 50% of previous year, 50% of current year. So they are going to receive this into 0.5. Once the project, okay, one adjustment I'll have to do here is this year alone I'll have to add this 75. I'll have to add this 75 because the project has got over. I would have recovered this 75 which is there in the project. Year 1 to 4 numbers are fine. Year 5 another 75 is there. Listen for some time. You note it later. Listen. Project has got over, so this entire amount will have to get repatriated, or entire amount will have to be met. The 6th year, there is no concept of 50-50. For the balance part, balance 50 is going to come like this. So I have taken the 66 crores, 50% in the current year, 50% in the next year. 64 crores, 50% in the current year, 50% in the next year. 70 crores current year, next year. 75 crores current year, next year. 161 crores current year, next year. And 19 crores, entire 19 crores will have to be paid. Any doubts till this? Any doubts on this? So total inflow to parent. This is the amount parent is going to get every year, considering the royalty payouts, considering everything. They will get this money: 33 crores, 65 crores, 67 crores, 72 crores, 118 crores and 61 crores. On this, tax in US. What is the tax rate in US? 30. Tax in US at 35%. So a year later, they are going to pay taxes a year later. That's what the question has said. They will get a credit. In both the countries, taxes are paid a year later. So I take this number, multiply with 35%. Okay, sorry. Before this, I'll have to do an adjustment. Okay, any doubts till total inflow to parent? Any doubts till total inflow to parent? 50% of the current year number, 50% of the next year number, 50% of the previous number. Complete till this. Complete till total inflow to parent. Complete till total inflow to parent. I want you to convert this in US dollar before calculating taxes, because finally calculation has to be done in terms of US dollar. 4 decimal computation. Convert into US dollars. The exchange rates are there in your notebook, so you'll have to convert it into US dollar. I'll summarize once it is done. In another 10-15 minutes we'll complete it, then I'll summarize it so that you understand it better. It's a comprehensive case study type of a problem wherein a lot of concepts are tested. Any doubts on the inflow to parent in INR? Then I've divided by the exchange rate. I get the parent inflows in US dollar. First in INR and then in US dollar. Inflow to parent in US dollars. Done till this? Okay, now I want you to listen for some time. Let me just complete the final calculation, then you can copy it. Listen. Tax payable in US, tax credit as per DTAA, and final tax paid. In US, I'll have to pay tax at what rate? 35% on the previous year profit. This is parent's profit. Whatever number the parent is going to get from the subsidiary or from the joint venture is technically their profit. On that they have to pay 35%. So these are the amounts parent has to pay. It has to go to year 7. You can write year 7 later on. But these are the taxes which the parent has to pay. What they will do is they will take tax credit as per DTAA provision for the taxes which have been paid in India. So in India they had paid these amounts. They had paid some taxes in India, so they are not going to pay again the tax on that. What tax they are going to pay is the net amount, which broadly will be equal to 5%, which broadly will be equal to 5%, but repatriation issues are there. 50-50, 50 in the first year, 50 in the next year. So they have to pay 35% of the previous year profit as tax. They have already paid some tax in India, so they want to take credit of that. After taking credit of them, they are going to pay this final amount. So net, the final number is net cash flow. The parent is going to get in year 1 0.5758 crores. Year 2, they are going to get 1.09, 0.98, 1.111, 1.92. This is what this parent entity is going to get out of making investment in India. 0.5758 crores, 1.0984 crores, 0.98 crores, 1.1119 crores, 1.92, 0.7068, and a year 7. I did not anticipate a year 7, but yes, year 7 will be needed because the US parent is going to get the cash flow. They will pay tax in the next year. They are going to pay tax in the next year, and they are going to take credit for whatever tax they have paid in India. Whatever taxes have been paid in India, they are going to take a credit. This is what DTAA provisions is talking here. You pay tax in India, take credit of that in USA, and they are eligible to get it. I am not very sure on the actual taxation side how it works, but in this question they have said you are eligible to get tax credit. So in US I am required to pay 0.20 crores. but I'll pay only 0.16 crores. I'll pay only 0.03 crores. Basically, I'll take a credit of whatever is already paid in India and balance amount. If I don't take credit of what is paid in India, I'll end up paying tax at the rate of 35 plus another 30, 65%. I'll end up paying tax at a higher rate. Clear? Any doubts on this? Complete this and get the net cash flow number. Complete this and get the net cash flow number. These are your final numbers. We are going to just discount this and get to the NPV of the project. We'll discount this number and get to the NPV of the project. We're working in crores US dollars, so it's better to work with 4 decimals. These are going to be the net cash flows as far as parent is concerned. 0.57 crores, 1.09, 0.98, 1.111, 1.92, 1.71. Yes. Let's just complete this. I'll explain it again once. We'll summarize it and then I go to the next problem. Any doubts in this? Any doubts till this stage? It has a lot of calculation. Ideally, I should have changed this question as 2-year problem so that concepts would remain same. Calculation could have been lower. It is just doing calculation, same calculation for 6 years, take a lot of time. 250. Working capital to initially 250 crores outflow. Clear? Can we proceed? Any doubts till this? Let's just quickly get the final NPV and then discuss this problem again. Any doubts till this? Last working note, computation of NPV. Friends, no discussions please. Year cash flow PVF at 15% DCF. Seven years project, year cash flow PVF at 15% and DCF. PVF at 15% and DCF. Any doubts on these numbers? Now, what was the initial outflow from the parent point of view? How many crores did invest? 250. So 250 I am converting. So my initial outflow was 4 crores, 4.386 crore dollars. First year I earned 0.5758. Second year earned 1.09. Third year 0.98. So invested 4 crores and this is what I get back every year. After investing 4 crores, 4 crore dollars, I have got back this amount. Your DCF work with 4 decimals, rounding off will play a big part here. See, my end objective was to get to this number. This is what I wanted to understand. Parent will invest 4 crores on day 0. They'll get back 0.57, 1.09, 0.98, 1.111, 1.92. Every year, they'll keep getting back some amounts. Discount this. Okay, because of time constraint, I would want you to just write the final answer. You can do the calculation later on at home or copy it. I don't want to spend time much. I just want to discuss more of it rather than spending time on calculation. My final NP will be negative 0.65. Final answer is negative NPV of 0.6535. You can just note that number. Calculation part is something which you can do later on. Year 1 number is 4.386. Balance is just a copy paste of the previous working note. It's just a copy paste of previous working note. The project will get rejected as there's a negative NPV. That's what is the final answer. Now listen, I don't want you to spend time in noting it down. Listen for some time. Let me just summarize what we had done. We had started with the calculation. My initial outflow is 2 parts. There's a capital expenditure and there is a working capital. On capital expenditure we spent 200 crores, working capital we had spent 5 crores. So any project which I do can have 2 kind of outflow. One is an initial outflow and second is one is a capital expenditure and second is working capital. When it comes to in between flow, I had to calculate the selling price. Different answers are possible for selling price. I think Institute has taken this 7.5, 8.5, 9.5, 10.5, 11.5 and then added the inflation. Then we had the royalty payout which was to happen. Royalty payout was a tricky calculation because I had to first forecast the exchange rate. For forecasting the exchange rate, we have used purchasing power parity theory and the inflation rates are different for different years. It started with 6, became 5.5, 5, 4.5, 4. So initially INR was depreciating and then it started appreciating. That's how the exchange rates were. So it started depreciating and then it finally started appreciating. There is some appreciation which had happened. So you convert the royalty into INR, add it up. My production cost says 40% of the revenue. There is a possibility, I am not sure what ICI finally did, but there is a possibility of taking this 40 percentage on not the overall revenues, taking this 40 percentage only on the pre-royalty revenues, 40 percentage on pre-royalty revenues. We consider tax a year later, that is another adjustment which is there. After getting the cash flow, 50% will come in the same year, balance 50% is going to come in the next year, which is a repatriation adjustment. On repatriation adjustment, I also had to give DTAA adjustment, which is finding out the tax in US, finding out what tax you have paid in India and deduct the tax paid in India, deduct the tax paid in India and only pay the net amount, and you get the final cash flow and start discounting it. Clear? Any doubts on this? Any doubts on this? I would want you to revise this question at home, so that, and there are 2 homework problems which are also comprehensive, which are also kind of comprehensive problem. When I discuss homework problems, when I record a video, I may discuss a little bit in detail, but those are also something comprehensive problem. The issue is you are not having touch with capital budgeting. At inter level, what you learn is only 10 or 15% of the overall capital budgeting. Balance area is ignored. In new syllabus, it's technically ignored. If I had done old syllabus analysis, there you do normal capital budgeting, and then I may not even discuss problems like this, because your normal capital budgeting will have more complex set of questions wherein you understand a lot of things. But here you are left with no choice, so you will have to go through this question in detail to understand how cash flows have been calculated. So understand cash flows. The important adjustment is, one is repatriation adjustment and the tax adjustment and your selling price calculation. These 3 are extremely critical adjustment in this question. So just go through this at home. Let me know if you have any doubts. Any doubts? I have different possible answers. I think ICI did not do year 7 calculation, but year 7 will be needed. There are possible different answers based on assumption which you take, based on the assumptions taken. Any doubts on this? Clear? Go through question 11. Go through 11. This is not on capital budgeting, this is on financing. Go through 11. Okay, I'll now start explaining this question. This is a practical application. Exactly, this is what happens in a practical world. This company wants to consolidate its operation into one building, so 90 crore. They are planning to go for a ECB, external commercial borrowing, which is of GBP 10 million. Average loan maturity will be 3.5 years, overall tenure of 5 years. What is average loan maturity is? Basically calculating something called as average due date. When I say average due date, initially 90 crores will be outstanding for 5 years. Then after 6 months, 85 crores could be outstanding for the balance 4.5 years. Then 80 crores could be outstanding, because every time you will keep paying. So what does this 3.4 technically means is my overall interest cost will be 90 crores into whatever the rate of interest, let's assume 10%, into 3.4 years. For the entire 5 year, the interest cost will be this much, because initially for 1 year you will pay interest on 90 crores, then you will pay interest on 75 crores, then you will pay interest on 60 crores, then you will end up paying it on 45 crores, because your interest outflow will keep coming down. So average loan maturity will make it simpler for me to calculate the interest. If average loan maturity is not given, and they say the loan is to be repaid every year, equal amount every year, then my interest calculation will be like this: 90 crore into 10% for the first year, second year 72 crore into 10%, third year 54 crore into 10%, so which will become a longer calculation. Instead of doing that, they have given something called as average loan maturity. This will help me in calculating the overall interest cost directly. Upfront fee is to be paid. Interest cost is basically the interest rate on this loan is 1.6 month LIBOR does not mean 6 month interest rate. Be very careful. 6 month LIBOR is basically a 6 month FD rate. It's basically like a 6 month FD rate. So my interest rate on this loan is going to be 1.05% plus 2.5%. 1.05 plus 2.5%. K Limited has also entered into a hedge to cover the exposure, and the cost of hedge is coming to 4%. Hedging your exposure, when you take a foreign currency loan, you will have a problem because GBP and INR can move anytime. If it moves, my outflows can go up significantly. So in order to protect ourselves, we normally enter into something called as interest cum currency swap. You will learn this in interest rate swap chapter. So somewhere you will enter into a swap transaction or a hedging transaction. What it does is it finally converts your foreign currency loan into an INR loan the moment you hedge it. Moment you hedge your foreign currency receivable, it becomes an Indian currency receivable. Moment it is hedged. Why it becomes an Indian currency receivable is you are not impacted by the foreign currency movement. Moment hedging is done. For hedging, there will be some expense, that is around 4%. In practical world, if I take a loan in foreign currency, it will be at these rates, 2 to 3%. But a lot of corporates, what they do is they don't hedge the transaction. If you don't hedge, the currency can move up, down significantly. Your final cost can even go up to 12, 15, 18 depending on how the currency has moved. If currency had not moved significantly, it will be at 5-6% types. If you hedge it, your hedging cost practically can be 5 to 6%, and you will end up taking a loan at 8 to 9%. This 8 to 9% is technically like an INR loan. This 8 to 9% is technically like a INR loan because you have hedged your transaction. Practically a lot of corporates do this. They take a foreign currency loan, convert into an Indian currency loan through a swap transaction, and pay an effective rate of 8 to 9%. They are okay with paying that 8 to 9% because Indian loan, if you directly take, you will get it at 9.5-10%. The only problem is a lot of companies will not be in a position to take a foreign currency loan. Many banks may not give them. So that can be a practical issue, but if corporates are eligible, they will try to take a foreign currency loan and hedge it. If you keep it open, my final effective borrowing rate can be 4%, 14%, 24%. It can be any of this. If you keep it open, that's the only problem. If I don't hedge the transaction, my effective rate can turn out to be 4%, 14%, 20. There's also one more problem. The interest rate on the loan is what? 6 month LIBOR plus 2.5. The LIBOR is expected to be 1.05, but it can even turn out to be 2%, it can even turn out to be 3%. Practically, there is a way to hedge yourself against the LIBOR movements also. You will learn that in interest rates chapter, but corporates would like to hedge it. Finally, as a CFO, I would like to know what is my effective cost. Don't give me saying that this is the cost provided these conditions are met. I don't want those conditions. Without conditions, what is going to be the effective cost? If you have to remove the conditions, you need to hedge the transaction. So once the hedging is done, I'll get to know what is my INR borrowing rate, what is my foreign currency converted into INR borrowing rate, and take a call which currency is to be taken for loan purpose, provided both are available. Now, calculate the overall cost both in percentage and rupee terms. Cost of hedging in rupee terms. If it pursues an aggressive approach, what would be the net gain or loss? What is aggressive approach? Is not taking a hedge. Aggressive approach is not going ahead with the hedging transaction, because you feel that what is the point of taking a hedge if things are going to fall good. Let me not take a hedge, and they take an aggressive stance and not take a hedge, and my currency depreciates or appreciates against GBP by 10%. Assuming that the loan is repaid in GBP at the end of 5 years, I'll have to ignore time value and taxes. I'll have to calculate what is the profit or loss which this company is going to get if they go for a non-hedging purpose. Non-hedging is, we had seen forward contract analysis. When we did forward contract analysis, we used to compare the forward rate with the expected spot rate in maturity and decide whether some profit or loss is made. That is if you cover the transaction. Sometimes if you don't cover, if you are not covering what payment you are making, what payment you could have made in case the hedging was done, because hedging will ensure that my final outflow is freeze. There is not going to be any adjustment to that outflow number. Working note 1, computation of overall cost in percentage and INR. Overall cost in percentage and INR. Particulars calculation amount. Point number 1, upfront premium. Upfront premium. How much is the premium to be paid? Yeah, read it and let me know what's the premium to be paid. Our upfront fee is upfront premium. 1 point. Okay, let me call it as upfront fee. How much is upfront fee? 1.2%. I'm first calculating it in pounds. I'll convert into INR in some time. My upfront fee is, how much is the loan I'm taking in GBP? 10 million. So 10 million into 1.2%. 10 million into 1.2%. 10 million into 1.2%. This is one payment which I have to make. 10 million into 1.2%. A fee which needs to be paid. Interest cost. First tell me what will be the interest rate on this loan. Adding that spread, LIBOR all put together, what is the interest rate? 3 point. Yeah, my interest rate on this loan is going to be 1.05 plus 2.5. Is this a 6-month rate or a yearly rate? This is going to be my yearly rate. Now listen, my interest calculation is 10 million into 3.55% into 3.4 years. I'll pay this for an average period of 3.4 years. Why 3.4 is, initially you will pay on 10 million, then you will pay on 9, 8, 7, 6, it will keep reducing. I don't have calculation on that, how the loan is to be paid. They have said average duration is going to be 3.4 years. How that average duration is technically calculated is 10 years, 10 million is outstanding for 5 years, 9 million is outstanding for 4 years. You would have done something called as average due date. That's technically, this is the calculation. You will do sum of product by sum of weights. This is technically like an average due date. How much is the average maturity of the loan? 10 million is outstanding for 5 years, 9 million is outstanding for 4 years, 8 million is outstanding for 3.5 years, 7 million is outstanding for 3 years. So I do a product of it, sum of product by sum of weight, something you would have learnt in average due date. That average due date is basically 3.4 years here. So 10 million into 3.55% into 3.4 years. Then hedging cost. Hedging cost. Same thing. What is the hedging percentage? I think it is 4%. Upfront fee, interest cost, and hedging cost. I've done everything as of now in pounds. We'll convert into INR in some time. Any doubts till this? Okay, now listen. This is my total cost for, guys, listen for some time. Any doubts on the calculation till now? This is my total cost for 3.4 years. It's not for 5 years because my average maturity is only 3.4 years. Listen for some time. I'll give you time to note down. Total cost per year. I would have directly done per year calculation if this issue was not there. If there was no upfront fee, everything I would have calculated per year directly and be done with it. In fact, if the upfront fee was not there, I would have directly told the answer is 7.55%, 3.55 plus another 4%. The answer is 7.55. Upfront fee 1.2% is technically for a period of 3.4 years. That 1.2% is technically for a period of 3.4 years. So you cannot directly add 1.2. So in that, if I want to get the per year rate, I should get 1.2 divided by 3.4. So I'm paying upfront fee which is only once, whereas interest cost has to be paid every year. So interest cost was calculated for 3.4 years. Hedging cost is also calculated for 3.4 years, and upfront fee is also calculated for 3.4 years. Technically it is for 3.4 years because it's a one-time payment. It's a one-time payment for the entire 3.4 years. Now why we have calculated per year cost is loan taken and borrowing rate or effective interest rate. What is the amount of loan we took? 10 million. Now ICI had given two answers, both are logical, they have given both the answer. Either you take it as 10 million or you take it as 9.88 million, because upfront fee will have to be paid to the banker immediately. Upfront fee is to be paid immediately. So when I go to the bank and ask for a loan, he may not even give me 10 million. He will give me only 9.88 million, saying that I am deducting my 1.2% charge. He is not going to pay me and collect that 0.12. So logically speaking, both are right. ICI has given both the answer. They have told you can take 10 million, you can also take 9.88 million. Both answers are possible. They have given both the solution in their material. I am taking it as 10 million. I'll give an alternate answer which is 9.88. Wait. So my final effective borrowing rate is 7.9%. I'm going to take a loan at the rate of 7.9%. What is that 7.9 is? Technically this 1.2 divided by 3.4, 3.55 and 4%. These are the three costs for me. This put together is that 7.90. This three costs put together is 7.90. 3.55 is annual cost, 4% is annual cost, 1.2 is not annual cost. 1.2 is not annual cost. So 1.2 divided by 3.4 years will technically give me the annual cost. Clear? Any doubts on this? Any doubts on this? This answers the percentage terms. The first part of the question says overall cost both in percentage and rupee terms on an annual basis. So we have done the effective interest rate, which is rupee percentage terms. I'll come to rupee in some time. Note now. Please write it. The basic calculation is what is happening in this problem is I have 3.55, I have 4. Upfront fee, if that mentioned that the fee is going to be 0.25% every year, then I would have added the 3 and got the answer directly. Upfront fee is one time payment, balance are yearly payment. So we have to convert. Next, effective interest cost INR. Effective interest cost is per year cost is this much into 90, exchange rate is 90. Exchange rate between INR and GBP is 90. So this into 90, this is in millions. The first 6 items were in GBP. My effective borrowing rate is 7.9% and my effective interest cost is 71.127 million. That's the annual cost I am going to pay. The effective borrowing rate is 71.127 million. What is the overall cost both in percentage and rupee term on an annual basis? On an annual basis they had asked this. What's the next thing question is asking? Okay, any doubts on 7.9 and 71 million? Any doubts on 7? This had come in exam, recent exam. This was asked for a 10 mark or a 8 mark question. Any doubts on this? 7.9 million and 7.9% and 71 million. Alternate answer could have been this is 9.88. So it would have become 8% and 71 million. That 71 million continues to be the same. I am not changing there, but it could have been 8%. It could have been 8% if I had taken 9.88 million. Both has its own set of logic. One logic is we had initially taken 10 million, so take it on the original amount. The other logic is net amount which I get is only 9.88 million. ICI has given both the answer. They have mentioned an alternative solution and they have given both. Any doubts till this? How do I get cost of hedging in rupee terms? It's available there. You tell me how do I get hedging cost in rupee terms? 1.36 million into 90, that's all. Next, cost of hedging INR, this into 90. Just do one extra calculation. This is for 3.4 years. Do for 1 year as well. That is for 3.4 years. So I am having an effective borrowing rate of 7.9%. Interest cost per year is 71 millions. Hedging cost is 36 million for a year or 122.4 million for the overall period. Any doubts on this? This problem is fairly simple. Any doubts on this? Can we proceed? Okay. Now think logically and tell me, your forex understanding will come into picture. If K Limited wants to pursue an aggressive approach indicates hedging is not done. What would be the net gain or loss for K Limited? One gain for K Limited is they will not pay any hedging cost. One gain for K Limited is no hedging cost to be paid by them, because they are not going to opt for hedging. So that is a saving which they are going to make. If INR depreciates or appreciates against GBP, I am asking you a question, you think logically and let me know. INR depreciates by 10%. INR depreciates by 10%. If INR is depreciating, is this a gain for the company or a loss for the company? If INR is depreciating, is this a gain for the company or a loss for the company? Think and let me know, is it a gain or loss? Loss. INR has depreciated, which means pound has appreciated, and if pound has appreciated, my liabilities have appreciated. Pound has appreciated, and pound has appreciated by how much? 10%, which means I am going to have a loss of 10 million into 10% or 90 crores into 10%. Logically, this 10% of INR depreciation is not GBP appreciation. I should do some calculation and get it will turn out to be some 9.9 or some number. ICIS, for simplicity's sake, they have just gone ahead with this 10% number. But I can do again a detailed calculation and get to know, because if a rupee depreciates by 10%, it does not mean pound has appreciated by 10%. We learned this in the appreciation depreciation chapter. There we had learnt it. Here the concept was not much testing on the appreciation depreciation. So ICI has simply taken it on 90 crores. So the company is going to face a loss of 90 crores into 10%. The company is going to face a loss of 90 crores into 10%. That is, my liability of 90 crore would have gone up to 99 crore. My liability of 90 crore would have, because my liability of 10 million will not go up. 10 million will remain same 10 million. But 90 crore will become 99 crore because pound has appreciated. So I lose 9 crores. I ideally should save this number. I am not going to follow what ICI has done. ICI has considered saving us 36 million. ICI is considered, I am not following ICI answer in this question. This part I cannot do it because my overall loss is 9 crores for a period of 5 years, because I am going to repay at the end of 5 years. Then my saving should ideally be 122.4 million, which is over a period of 5 years. My saving should have been 122.4 million. ICI in their solution have considered saving to be 36 million. The hedging cost saving is considered to be 36 million, which is a per year saving, I am not following that solution because logically it does not fit in. I cannot give a logic saying why I take a per year saving when I am calculating the cost there at a 5 year level. So now scenario 1, GBP, scenario 1, INR depreciates, scenario 1, INR depreciates by 10%. INR depreciates by 10% slash INR depreciates by 10% slash GBP appreciate by 10% slash GBP appreciate by 10%. Point number 1, the company has taken a loan in, GBP, company has taken a loan in GBP, full stop. They have taken an aggressive approach, which mean hedging is not done, Next point, my liability is in GBP, and GBP has appreciated. Full stop. This will lead to a loss of 90 crore into 10%, 9 crores. next point, the company has not hedged, the company has not hedged, and hence it would save 12.24 crores. It would save 12.24 crores. Full stop. Net saving equal to net gain equal to 3.24 crores. Net gain equal to 3.24 crores. Write a similar explanation when INR appreciates. Write a similar explanation, INR appreciating by 10%. Uh, the scenario is INR has appreciated by 10%. Friends, please maintain silence. INR has appreciated by 10%. That's the scenario. If INR appreciates by 10%, pound would have depreciated. My liabilities have depreciated, and because of that, I have a gain of 9 crores. I have a gain of 9 crores. On top of that, I save hedging cost of 12.24 crores. One, there is a gain of 9 crores because of depreciation of pound, and on top of that, I'll save another 12.24 crores. So overall, put together, I'll save some 21 crores. Put together, we are going to save 21 crores. 9 crores because depreciation of pound, another 12 crores because of hedging. Any doubts on that? So there is a saving of how much is the overall saving? 21.24. Overall saving is 21. That is not going to match with ICI solution. ICI has matched it with hedging saving as 3.6 crore. ICI answer hedging saving is 3.6 crore, which is a per year number. They have taken a per year number. Logically, it didn't fit in. So I have done this way. Clear? Any doubts on this? Which number? This is directly, no, into 90. It's in short 900 million into 4%. 90 crores into 4%. That's the calculation. I had earlier done it in pounds. I've converted that into INR. It's basically 90 crores into 4%. That's the hedging cost.